Hello everyone, welcome to our today's class. We're going today to talk about another important component of successful trading, risk management. So in order to complete all the preparations and start trading, you have to consider risk management, as this is one of the key points in financial trading and requires a lot of attention. So what is risk management? By definition, is a tool that identifies potential risks in advance, analyzes them, and take step in order to reduce the negative impact. So in other words, risk management, main aim of risk management is to minimize negative impact from one side, and from the other side to enhance the opportunities. So we're trying to make our trading less risky and more successful. So risk management is quite necessary in the process of trading. Or in any investment, any trading brings quite a big exposure to various risks, and the duty of traders is to recognize them and to control the exposure to such risks, because if we don't control, then risk of wiping out our trading account would grow progressively, and then within short period of time we'll stay without money, and this is exactly what we're trying to avoid. So there are the various risks that traders are exposed in trading, and of course by choosing different instruments in the market, they bring different levels or different grades of risk. So if we take let's say fixed deposit, which is the less risky, because it gives you certain guarantee that you will get certain amount, fixed amount at the end when it expires, in comparison to the trading in Forex or even in equities, which makes the risk much higher level. Of course, on the other side, the profits, potential profits, are much higher. So we need to control and curb this risk in order to last in the market, first of all, and secondly, to try to make money rather than losing money. Traders, before they start trading, we spoke about this in one of our previous classes, need to have plan. Plan is the key thing that will lead us towards successful trading, not trading with losses. The worst thing is just to jump in the market, randomly take instruments, and God help us, what will happen. So we're exactly trying to avoid this, and we're trying to learn how it's what are the components, and how important they are, and how they can interfere our trading, how they can improve our trading in the market. So the plan is one of the first things that we need to create, and we need to stick to this plan. And every trading plan, apart from choosing instruments and all other things that are included, is must be accompanied with the risk management. Risk management is one of the also key components of the trading plan, and its aim is basically to keep you alive in trading way, of course, to keep you in the market, to keep you afloat, not to let you lose your money, wipe out your account in a short period of time. And when we have all these tools that are necessary, prepared in a proper way, and the risk control and money management will be the main starting points of successful trading. So we're trying basically not to make money, we're trying to reduce risk exposure. By reducing risk, you are automatically on the other side increasing opportunities to make money, because if you are not considering how serious is the risk, and if you cannot recognize at the certain position that you have, whether it's risky or not, or it's highly risky, then it's quite dangerous that you might get in troubles very soon, and then with the bad consequences that we are trying to avoid. One of the things that are quite popular nowadays, and on the other side quite dangerous, is leverage. Leverage is that every broker offers, facilitates its traders by allowing them to enter markets by multiplying their initial deposit, and depending, of course, of the level of the leverage, it could go to quite significant amounts. But mind that this is not your money. This is just some facility that allows you to trade much higher amounts from the initial deposit, and this could be quite risky. So risk management is used to control and manage exposure, even if you are trading with leverage. That is nowadays, I could say, a must among the traders. And proper money management is there to take care of your initial capital, to preserve it, to protect it, and not to let you, as sometimes human factor could be very dangerous, to go into the more losses or risk losing a whole deposit by some trading, some wrong decisions, or chasing the price after several losses. Things that are risk management is used basically to avoid and to stop these things and keep you in the market and keep you on the right track. So risk management helps you to limit potential losses, and also to avoid danger of of losing all your money from the account, your deposit, which we are trying to avoid. So as we said, the leverage is the amount of a position that you can operate, you can trade with the given amount of money. So if your deposit is certain X number of dollars, then the leverage facilitates you with the 10, 20, 50, 100 times, depending on the leverage offered, to be able to trade much bigger amounts than it's your initial deposit. So we have a sample. Let's say if leverage is 20 to 1, if you have $1,000, then you'll be able to operate with the $20,000. But let's say if it's 100 to 1, then with your $1,000 will become in trading, will get the value of $100,000. This from one side brings you opportunity to multiply your profits. Of course, when you have only $1,000 in your trading account and you are entitled to trade with 100,000, so 100 times more, this increases, of course, the opportunities to make money. But we need to especially point on this. It has the other side, which is negative. So if you have opportunity to make much higher profits from your initial trading account, you can also produce the same size of losses. So we have to be very careful with this, and risk management is one of the tools that is trying to prevent these risky things, along with the other things, and of course the most important human factor, which is you as a trader. So you need to handle all these tools, and you need to handle yourself as a human factor, because humans sometimes are think too fast or do not think at all, and jump into the obvious danger by just greediness or not thinking enough or not controlling things. There are various factors, and we have all faced this many times in our lives, when you just blindly go, as we say, going through the wall, trying to go through the wall, and then when you hit the wall, then you realize that you were wrong. But sometimes, and many times actually, it's a bit too late to fix the problem. So by using risk management, we're trying to avoid such situations when we will come in extended or increase the danger, and we're trying to keep the things on the right track and move towards a profitable side rather than the losing side. So the trading model that we use, the plan in our plan, is one of also important things, and we need to find the one that is suitable for us. This is what we spoke in our previous classes, and we need to stick to that plan, because this is also important part of risk management. If we are just jumping from one model to the other, one style to the other style, we are not satisfied. If we make one loss on that model of trading, doesn't mean that we are right. On contrary, it could mean that we are just not following strictly the plan, and we are just missing some important points. So the trader needs to stick to that plan, probably to test it several times to see their weak points, to find out, and not necessarily that plan will work every time with success. It could produce losses, of course. So we need to stick. One of the important points is to stick to that plan and follow it as we decided, because the plan is created by us and it's our decision. So we have to find something that is very suitable for us. And if there are mistakes happen. So we can just modify that plan, adjust it, fine tune it, but we need to stick it. Trader, when trading, needs to take emotions out. The emotions are one of the very dangerous things in trading. You need to take these emotions out to think clearly, and this will lead you to spot proper and good opportunities, and to make correct trading decisions. And also you need to hold a neutral outlook. It's bad if you expect market to go in one direction and temporarily market is going against you, so you are already panicking. I don't think it's the right way. It's when you are neutral, then you can expect certain direction, that is your prevailing trend, but you can also expect movements in the opposite direction. But more important is that you can see the bigger picture, and you can know what is exactly going on, so you will not be hit by some corrective action in the market. If you have a major trend that lasts for a certain period of time and then you have some move against, more likely that this will be correction until, of course, unless you get the signal that is reversal. So it's not a surprise for you. You see the bigger picture, you know how the market is moving and what is prevailing direction and what could we expect in the corrective action. So we need to hold this neutral tone, neutral outlook, in order to be able to understand market movements and to react accordingly and on time. Some experienced traders, actually most of experienced traders, stick to these plans and strategies, and they choose those that after several testing, then they choose those who showed the best results. So you can make several strategies and choose which one is the most suitable for you, which one gives the best results. This is again a personal thing. You need to find something that suits you, that you feel comfortable when using your trading strategy, and of course the most important, that strategy is giving results. Now, talking about main risk points, there is a risk, again, it's a psychological problem with the human factor again. Sometimes we have simply bad days, and we make several wrong decisions, and which end in losing trades. This usually drags a number of traders. I would say those more less experienced more than those who are more experienced, but no one is 100% sure that will be avoiding such a thing. But this is in human nature. So we have a situation when we make several losses, several trades with the loss in a row, and then we get upset. And then the first thinking is, I need to recover these losses. And then you put yourself into a very dangerous situation, because you will not be able to catch. Probably, yes, in certain suitable market corrections, favorable market market conditions, pardon, but generally it's quite risky. And exactly the reaction should be exactly opposite. Never let yourself into danger to chase the market in order to cover your losses. You will not be able to do these things in most situations. You will not be able to do it, but rather react accordingly. As we said, you have to be calm, you have to think clearly. So if I made some losses in the past few days or few hours or whatever, then I need to step on the ball and reduce my exposure, reduce my trades, rather than jumping and multiplying what number of traders do. So when they lose $500 and they have leverage 100 to 1, and they have, let's say, $10,000 in the account, then they jump for 1 million straight away in order to cover losses, and this is wrong. Because by default, I would say, most of people are blinded at that time, and they just see only one thing: profit. This is wrong, or covering loss. So it's the best thing, according to risk management, is to reduce, let's say, by 50%, and continue trading. Or if you feel that you are overloaded, that you need a break or something, just stop trading. Stop trading, analyze your mistakes. Meantime, see what were the problems, what caused these problems. And once you feel you are ready, you can re-enter the market. You may again recognize some opportunities. Maybe there was a move against you in the major trend, which showed as a small correction, but unfortunately it extended in causing you more and more losses. So you need to see, let's say, when this correction ends, then you re-enter market again, and then it will be more successful. You always analyze your mistakes. So this is what I said: when you stop trading, take a look, trade by trade. What did you do? What were the signals at that time? What were your expectations, and how market reacted? It's not always that we are 100% right, that we can predict market movements. No. We are doing our best using all the tools that we have available, but mistakes happen, of course. Sometimes it's a typical human factor mistake, by not thinking enough, by not analyzing deeply the situation, by not recognizing the right opportunity, rather simply jumping into the market or chasing prices to recover our losses. So there are plenty of things that could cause more troubles, more problems to a trader. So the best thing is first reduce your exposure if you are planning to continue trading, or simply take a break, finish the trading for that day or for that week. Not necessarily that you trade every day. You may make one trade per day, maybe 1 to 3 trades per week, depending on the situation in the market, depending on a number of factors, depending how you feel, whether you are you can be fully concentrated or not, whether you can clearly think or not, when some things are distracting you. So the best thing in such a case is stop it, take a break, and return back when you are when you feel in the positive and good condition to continue trading, because analyzing market and recognizing good opportunities as difficult as profit making. So we need to be 100% fit to do this, and risk management helps us to reduce any risky points. So when we make several losses, which happens, no one can skip it, depending again on the on your luck on one side, but mainly on not following rules, or being not fully concentrated, or making repeated mistakes on chasing prices. So you need to return back to step on the ball and find out what were the wrong steps that you did, and re-enter market when you see the good opportunity again. Also important, risk management, as said, is there to protect your initial investment, your capital. So you have to handle your capital in a proper manner, and not to gamble with it, which means if you have 1,000 and you invest whole 1,000 into something, like being sure that you are going to be very profitable, that's a sort of gambling. So you don't think about tomorrow. Yes, you may catch some good move and multiply or triple your deposit, but it's a two-edged sword. So you have to consider that as much as you have possibilities of profiting, there is another on the other side that much equal size of risk. So you have to be sure what you do. So the good thing is that you can decide certain percentage that you will of your capital that you will use per trade. Let's say 1%, 2%, or 5%, again depending on the size of your initial deposit. So if you have 1% of $1,000, it's not much, it's $10. But if you make several trades and you make let's say 7% of your initial amount of the deposit, then it's a good result. So you have to see it from that point. You don't say I made only $70 today, it's nothing. No, you made 7% of your initial deposit. Ask bankers or businessmen, what does this mean to make 7% per year, not per day? So you will see that it works. It just needs to be seen from the other side a bit. You just move a few steps to the side and see the problem from the other perspective, and then you will see that this is quite a good thing. You need to prevent yourself from entering market with the big amounts. That's what we said in order to either try to multiply your profits, expectations for profits, or to cover losses, which is even more dangerous. We need to have a discipline in trading. This is something that we already mentioned several times in our previous classes. So discipline is following strictly everything that you decided before trading. When you put your plan and your strategy and everything, you need to follow it, because this will keep you on track with the minimum risk and will keep you away from price chasing to cover losses, which is we already mentioned one of the most dangerous things in the trading. So keep your original method, the original model of trading, original strategy. Don't get discouraged if you see some movements in the market against you. This happens. Market is not one straight line. Market moves in waves, in cycles, swings. So we need to consider this as a market movements. And keep testing this strategy until it starts giving positive results. Again, if there is a move in the opposite direction, doesn't mean that it's going to last forever. It's correction. Of course, you need to be careful, and as we said at the beginning, take a certain percentage of your capital and don't increase it. So you stick to your policy that I'm going to use 1% of my capital per trade, and then you will greatly reduce risk of losing money. Risk management is all about reducing risk of losing money, not making money. This making money comes on the opposite side, because if you have proper risk management and you are, I'm repeating this again, and you reduce your negative risks, then of course risk for making profitable trades is increasing. Opportunity actually for profitable trades is increasing. So stick to your methods regardless to the market conditions. Of course, you can always test this trading in case what we said previously, that you need to take a break from trading. You can just jump to the demo account, which doesn't cost anything, and you can play as much as you like. Consider that this is also a real account, so to have the similar feeling and test your strategies, your plans, your things on this. And you can also spot the weak points of your plan and then modify them. But the main thing is to fine tune your trading plan and strategy, and in order to get rid of negative points and to keep only the positive one, which will greatly increase probability of being profitable rather than losing. So the key thing is to be disciplined in trading, to follow strictly your rules and plans that you created, and keep testing your strategies until you see that they are profitable again, that they are giving good results. What is also important is the attitude of trader. As I said, the human being is quite a difficult creature, and we all have some feelings and attitudes, and usually these things that we don't like to feel, but they come on their own. Usually they appear when we are in stressful situations. So when we start losing money, we take it personally, we get nervous, we get upset. We don't see not bigger picture, but we don't see even the smaller picture, because we are pressured by this loss, and we try to recover immediately. So this is a paradox of the human beings, traders actually, who try immediately to cover the losses. Risk management will help you if you get even in the losses, which is in a way inevitable in trading in the markets, but we need to curb them, we need to reduce them, we need to bring them to the minimum in order to first of all preserve and keep our initial deposit, and secondly is to start building profits. So if we are protected, well protected from one side, then the other side will be open for success. So do not take it personally. If something happens, it happened. We can stop trading at that moment. We can analyze all the trades, spot our mistakes. You have to be very realistic with yourself when you see that there is a mistake. So where did I make mistakes? So the best thing is to analyze it, to spot weak points, to spot what helped you actually in a negative way to reach the losses, and how to avoid it. Second thing is important. This is all about risk management. You need to react when the market starts moving against you. You need to react. The worst thing is, and I've seen it in my career many times, trader says, okay, it's okay, it's going to be a correction, small correction, I'm okay, I'm positive, it's going to reverse to the other side. Until you wait and to see this reversal, it might happen, but in many cases, if you had $2 million dollar account, then you are okay. You can say, okay, I'll be waiting. I can wait for another 3-4 figures of the market move before I react. So yes, but if we are trading with $1,000 amounts, and we said leverage is greatly increasing opportunity for profits, but on the other side is greatly increasing risk of losses. So we have to think in advance. We have to prevent stronger losses. So we need to cut our losing positions. This is another problem of a number of traders, that they feel bad to cut losing position because it might have reverse. I'm sure that it's going to reverse very soon, so it's pity to cut it now. And this is, you are lying to yourself. Actually, you are not lying to me or to your fellow traders, but you lie to yourself. You think that yes, it is possible, theoretically it is possible that market will reverse and maybe shoot 300 points above. But will your account be able to stand this, or you'll be wiped out, and then this reversal with the skyrocketing market will follow? Usually this is what happens in the market. And the big traders jump in, wipe out all small ones, take their stops, and then continue in the original direction. So you cannot have luxury to chase the market. You cannot have luxury to play with the big market with small amount of money. So this is what we mentioned in the previous class, respect the market. So market is much bigger than me, you, or any trader. So we have to respect this. It's like a beast. So we have to respect and swim with the current. Swimming against the current is quite risky. So you have to cut losing position despite bad feeling. Yes, sometimes it's difficult, but think that it's better to lose $50 than $150. So then you can calm down with these bad feelings. Do not let losing position run. You have to put the stop loss, calculate according to your risk management, according to your preferences, and according to the percentage that you decided that you can lose. So if you say, let's say it's 1% loss I can afford, then I have to place stop loss order. And once the market hits this stop order, you are out. Do not keep moving. Many traders make this mistake. Let's extend it a bit. Let's extend it a bit. And from initial loss of $50 becomes $200. And then they realize that it's going to wipe out their account. And they cut the position well below or well above their initial stop loss order and tripling their losses just for something that should have been avoided from the beginning. Because when you decide about your risk management, then you have steps that you need to follow one by one. You cannot make it, okay, let's make it elastic a bit here, let's move it here. Then you don't follow the rule. It's the same thing what we mentioned in the previous class about day trading. I will leave this position until tomorrow because it looks to me that it's going to run more. So you are not day trader anymore. Now you are talking about something else. So the same thing is you have to be very strict with this. Stop loss order. Do not let the price, your position run beyond this determined calculated level. Let it get cut no matter how bad it's feeling, because if you don't let it cut, it may wipe out your account. At the same time, you have to keep an eye on your watch list, your plan, and see other opportunities. It's not the pressure from losing money at a certain point. It's just seeking for other opportunities that will help you to come with the profits. So at the end, you may come at 0 or slightly positive. So at the end of the trading day, you can underline and say, okay, I'm 1% positive, far away from my plan of making 5%, let's say, for that day, with risk of 1%, but I could have lost all my money because of wrong move. But unfortunately, I had my risk plan there, and I put my stop loss order, and I minimized the risk. I minimized the loss. And many traders get upset and by losing a series of losing positions, make them upset, which is normal. Most of people react. No one likes to lose money. Unfortunately, this money became very important in our lives nowadays in this material world. So we have to have certain money management, certain risk management in order to go towards making money, not losing money. So when you lose some positions, some money on wrong decisions or wrong move in the market that happens, do not get upset, because it will distract you from following the market and looking for other opportunities which will help you to, in a way, recover your losses or make some extra profits or whatever, because you are upset from the beginning. Why did I lose money? And then whole your world is in these trades. You're fully focused to the losing trades that are already closed. So you have already lost. rather than focusing in the market and looking for fresh opportunities that could be very good, and you simply don't see them because you are upset by losing money. Control is one of also key points in risk management. You have to be always in control, so you have to follow your position at risk, which is very important, because risk management is all about reducing risk of losing money, not just making money, just reducing the risk of losing money. And you have to think that way rather than thinking, as many traders do, how much money I'm going to make. So they're blind, literally, when they see some things that look good and how much money I'm going to make. You don't think this way, because it will make you blind for any other risky things, and most likely you will get trapped into these wrong positions, and that will lead in serious losses that we are trying to avoid. So one of the also important things of risk management is to economize with your money, to manage it properly. So do not trade the amount that you cannot afford to lose. This is what we were talking about in some of the previous sessions about stop loss orders. You have to sacrifice certain amount of money that you can afford, that your account can afford. So if you are having, let's say, 3% profit, planned profit, then you can risk 1% on the wrong side. So you will be within the standard, I would say, ratio of profit loss ratio. So you can afford some money. If you have $1,000, 1% is $10, so you can afford it. But if you have a $1,000 account and you are playing with the risk of losing $800, then something is very wrong in your strategy, in your planning, and you have to stop the trading and redo all the plans again, because by losing 80% of your account is disaster. It's disaster scenario, and no trader wants to do this. It's a gambling. So you have to be establish the trading in a safely mode. You need to choose decide how much you are going to you can afford to lose, and you can then you can decide about appropriate size of the trading contract that you are going to do according to your account balance. Now, stop loss orders are very important things. This is what we already mentioned. I need to stress it again. Do not miss to put stop order, because you have certain guarantee in the market. You may catch some slippage. This happens in case of a strong sudden move. Usually stops are placed at some significant levels in the market. You can recognize them by technical indicators. Most of traders use these technical indicators to spot strong support or resistance points and park their stops just slightly above or below these levels. And of course, when these levels are hit or broken, then the number of stops triggered and accelerate market further. So yes, there is a risk of increasing, of catching slippage, getting price slightly worse than you initially wanted, but this is not the rule. It happens. But when you have certain calculation of how much you can afford losing, and you place the stop order, then you limit your loss. So you have proper risk management with the $1,000 of initial deposit. You are willing to lose 1%, and you are planning to make 3%, let's say, if the market is in favorable direction and conditions. So stop order is something that should not be missed at any time. Once you execute the trade, you enter the market, you calculate quickly how much you are willing or you can afford losing, and straight away put your stop order. You never know what could happen in the market. And do not touch that order. Do not keep moving it. You can keep moving if the market goes with you in your direction. Then, of course, you will start lifting or lowering your stop order in order to confirm your profit, and keep increasing your profit once you become above zero or below zero, depending on which direction. But stop loss order is something that is very important and greatly reduces the risk of getting into the difficult situation if the market suddenly moves against you and starts moving in that wrong direction. So when you have stop loss order, you accepted certain amount to be lost, and you are prepared for this. I think I mentioned in one of the previous classes that I usually forget about this money. I consider it lost already. No matter that stop loss order was not hit yet, I consider it lost. So I'm relaxed from one side. I decided to lose this money. I lost it. So I don't have pressure. I'm focusing now on the other side and my strategies and my plans. So I don't have pressure, because usually traders react negatively on this. When the market starts moving in the wrong direction, they started reacting very negatively. They get tense, they get stressed, they cannot see the picture as it is anymore. They're just focusing if their stop is going to be hit or not. If it's going to be hit, it's going to be hit. You consider that this is the money you can afford losing, so let it be. If it happens, you lost certain percentage that you can afford, but you didn't put your entire deposit, your entire balance at risk like many traders do. They just sure that they're just sure that the market will move in their favor, in their direction, and they don't care about stops. And when the market starts moving, then they start first saying, okay, this is just a small correction, then it's going to stop and it's going to reverse until they realize that they are close to wipe out their account. Then they jump in the market and cut their losing position with the maximum loss. As usually, the market reverses after that, and then they get more upset why they didn't wait. You don't wait. You have your planned amount that you are willing to risk, and you put your stop accordingly, and your position is protected. On the other side, you have to also consider about profit, because we are all aiming to make profit, not loss. So calculating by analyzing market movements, analyzing support level orders, expectations on certain news releases, how the market will react, will help us to determine how much we are planning to make and where the market could go. Usually, ratio between the losing and the profiting is 1 to 3. So on 1 unit of loss, we put 3 units of profit. Could be 1 to 2 or 1 to 3. These are the sort of standard things. I would say 1 to 3 is acceptable, because some people think that why should I lose the same amount that I'm planning to make? You are not going to lose. If you lose it, you lost it. No matter, you could have put 10 times profit, but if the market moves in the wrong direction, so that's it. But if you put 1 to 3, let's say, and the market is in your favor, moving in your favor, then you have a great opportunity to make profit, as you will start adjusting your stop loss order as the market proceeds. And once the order is hit, you can just collect your profit. Important to mention in this case that many traders put the order exactly on certain resistance or support levels, and usually they act as strong points. So sometimes, and many times actually, market hesitates to hit these levels, and also knowing that there are a number of stops sparked just below or above them, depending on the market direction. They are also pressuring the price action, and they might not be hit, or simply you can see that market is trying but cannot reach your level. It's good if it's close to the to your take profit order. It's not bad idea to cut your position with the profit, of course. Risk these few pips or 10 pips or 20 pips, whatever it is, and book your profit, because it's better to have profit in your account rather than floating profit in the position, because next day it could be a floating loss. You never know how the market will react. So these are the most important things. Actually, I wanted to say that today's class is the first part of the risk management. We're going to continue and next week, in the next session, we're going to talk more about risk management and things that are related to this. So for today, we have the first part finished.